Hi, I'm Pattu from Frequent Cal, and in this video, let's take a look at Tata Equity PE Fund and when to use this kind of fund and how. So, why is it called the PE fund? It's called the PE fund because it has a mandate to invest in stocks, or at least it has a mandate to buy stocks, I would say, which at the time of buying should have the last 1 year average of the of its PE ratio to be lower than that of the last 1 year average of the Sensex PE. So at the time of buying, this criteria should be satisfied, and it should be holding 70% of such stocks at all times. Of course, this is only applicable at the time of buying. After that, it can if the stock's PE is higher, that's fine. It will still continue to hold it. It will not sell it. So in that sense, it's not a fully value oriented fund. It's only value oriented at the time of buying, and it can also invest up to 30% in growth stocks and also up to 20% in bonds. It also considers other factors like low price to book ratio, low price to cash flow, low price by earnings multiple, and high dividend yields, typically used for selecting value stocks. But even though this all these other parameters are satisfactory, it still will buy a stock only if that PE criterion, 12-month PE ratio, uh, 12-month rolling PE ratio will be lower than that of the Sensex. Since it was launched in May 2004, it had a very poor run up to about December 2013. If you look at the point-to-point return from that point to that point, and but then since then it's picked up. It has an AUM now of about 5,600 crores. This may be this kind of an extended underperformance can be a problem for this kind of fund, because I mean, there can be a situation where the entire market is down. So you may not when every stock is down, it's hard to find what is valuable and what is not. So it's a little tricky, and also when there is a bull run, it may be difficult to buy stocks which have that momentum, because you have this P criteria. So because of those factors, it could be difficult for this fund to. I mean, it can be there. I mean, there can be periods where this fund is underperforming, and the investors must be ready to face it. Now we'll go on to my usual annoying color charts. So the first chart I have for you is comparison of 7-year returns. So the red line that you see is Nifty 500. The white line is Nifty 500 Value Index. This is a factor-based index where 50 stocks which satisfy the value criteria, low PE, low PB, high dividend yield, etc., etc. You can see that in the NSE website. 50 stocks are chosen. This will always have the value stocks, unlike Tata or any other value fund. This will always have value stocks, and that's a problem, as you can see. And it also has the Nifty Large Mid Cap 250 Index, which is 100%. Sorry, which is 50% large Nifty 100 and 50% of Nifty Mid Cap 150. So the yellow is the Tata fund. The Tata fund. The pink is the Nifty Large Mid Cap 250. The white is the Nifty 500 Value 50 fund. So you can see that over 7-year periods, there are 1,200 7-year data points in each of those colored lines. Over 7-year periods, the fund has managed to outperform all the benchmark indices shown. And also notice that the Nifty 500 Value 50 fund has been underperforming in the last couple of years, and that's a problem with an algorithm-based value fund. That's very important. I think that's one of my biggest takeaways from this analysis is a factor-based value investing approach may be problematic. Sorry, that cut for a moment. So this is the standard deviation over 7 years. That is, you take the monthly returns and you find out how much they deviate from the monthly average over 7 years, and that's called the standard deviation. It's a measure of risk. Just like you have returns, rolling returns, this is a measure of rolling risk. Higher the line, the more the risk, and you can see that the Nifty 500 Value 50 fund has the highest in terms of rolling risk and all others along with the Tata index are more or less the same. So I'm sorry, let me just go back here. So this is I am now okay. Again, this is the same thing over comparison with peers, but over 5 years. Again, notice Tata Fund has done reasonably well. There's no problem there. But again, notice the Nifty 500 value 50. There are two periods of underperformance here and also here. So again, a factor-based or an algorithm-based value investing may be a little difficult to carry out. I am preparing for a talk on momentum investing and low volatility investing, and this will be one of the key points that I make in against value investing per se, because it's very subjective. It depends on the fund manager. It depends on who is picking, and that's the reason why I would personally not am not in favor of value investing. The green that you see is an Invesco Contra Fund. The blue is Quantum Long Term Equity. The brown is ICICI Value Discovery, and the yellow is the Tata PE fund. This is a 5-year rolling returns. There's not much to say about which is better and which is worse, except that one thing that I can see that Quantum Long-Term Equity has underperformed in the last couple of years. Other than that, there's not much. This is again the risk data, the rolling risk data over 5 years. Quantum Long-Term Equity has the lowest risk, but that alone is not enough. It has to do reasonably well in terms of return as well. So that they should take care of it. I think it's time for Quantum Long-Term Equity to turn around and start performing. And this is the peer comparison over 7 years. ICICI Value Discovery has a better record in terms of peer performance, although in the last couple of years it has more or less merged with the other funds. This outperformance may not come back again because its AUM has increased quite a bit since this kind of time, where it was less than half around this period and so on. Of its current AUM, about 8,000, 9,000 crores and so on. Okay, now it's about 16,000 crores. Quantum Long-Term Equity again has failed to impress in the last couple of years when you consider 7-year returns, and I think it's time for that fund to come good and make a difference in the space. It can be a very, very frustrating hold for its investors. So Tata Equity has done well. It's definitely a good pick if you want to choose a value-oriented fund in a category. For example, if you feel ICICI Value Discovery has too much AUM, you can consider this fund if you are interested in the value-oriented category. But please be clear that all value-oriented funds will go through a period of lull. They will not be able to outperform the index consistently at all times. So you cannot be using it for short-term goals like 7-year, 8-year, 10-year goals. Use it for truly long-term goals. Use it as part of a well-diversified portfolio. Otherwise, it can hurt a lot. If you're using value-oriented funds, you must use an aggressive growth fund to balance out the portfolio. Otherwise, it will be problematic. Also, this fund has this formula-like investment. Of course, it is only at the time of buying. So still, it can the past for this fund can repeat where it went through a period of underperformance. That can happen again. So you must be ready for such things. So it's not for everybody, but if you're up for it, I mean, don't get enamored by all this value investing. Warren Buffett said this, Charlie Munger said this, and so on, and get into all these funds. Mutual fund investing, value investing, and value investing as a direct equity investor are completely different. Both have their problems, but they're different sets of problems, and you must be ready to handle. So I'll catch you again in another video.